This is Street Signals, a weekly conversation about markets and macro brought to you by State Street Markets. I'm your host, Tim Graff, head of macro strategy for Europe. Each week, we talk about the latest insights from our award-winning research, as well as the current thinking from our strategists, traders, business leaders, clients, and other experts from financial markets. If you listen to us and like what you're hearing, please subscribe, leave us a good review, get in touch. It all helps us to improve what we offer. With that, here's what's on our minds this week. Like so many episodes I do these days, this one comes with an explanation on its timing. I talked to Noel Dixon on Monday. He's a senior macro strategist on our team in Boston, all about the current disruptions to global energy supply, where they rank in historical context, what they mean for the macro environment, markets, and the U.S. political process. A lot of that is what you'll hear, but as I was putting the finishing touches on things this morning, news broke of an apparent agreement between the U.S. and Iran to end hostilities and presumably open the Strait of Hormuz. If realized, and I should say that is still a very big if, it obviously does change the nature of a few of the questions I asked and some of the answers that Noel gave. So bear that in mind as you listen. But end of the day, almost no matter what, energy supply disruptions will likely persist in some form for some time longer. Those macro impacts will still be felt, and much of the forward-looking content you're about to hear is as relevant now as it was 24 hours ago when we recorded this. Enjoy. How's it going, man?
Good. How are you?
I'm all right. All right. Last thing I got to do today,
Oh, that's good.
save the best for last.
There you go.
Noel, great to have you back on. I want to come at this from, well, there's a few topics I want to talk about, but really putting this in the context of historic energy shocks and how this one looks. And I'm thinking, back to the 1973 oil embargo, that effectively was an energy price shock that ended a bull market in risk assets. But then you had the Iraq invasion of Kuwait, which was an energy price shock that really didn't do much other than interrupt a bull market. You had the Iraq war in 2004, which similarly didn't disrupt things too much, even though it was an energy price shock. I mean, where do you put this one in terms of the effect on energy supply and more importantly, the potential for scarcity in energy markets?
Yeah, absolutely. That's a great question. I think the one thing to point out is that there is no comparison relative to history to what we're facing now with the Strait of Hormuz. And just to give some context, 20% of the global supply of energy has been disrupted as a result of this. The only other scenario, or the largest second scenario from this, was the Arab oil embargo in 1973, and that only constrained supply by about 6 or 7%. So this is, probably 3 times as bad as past situations and on average. So it is a major disruption. What is fair to point out, however, is that there have been efforts to circumvent the Strait of Hormuz by several countries. So Saudi Arabia, they attempted to facilitate what they call the East-West pipeline, where the goal is to get to 6 to 7 million barrels per day. It's actually been about maybe 5.5 million barrels per day. The UAE, they have the Habshan Fujairah production facility that goes straight to the Gulf of Oman, and that has reached about maybe 1.5 million barrels per day. And then you have the Iraq to Kirkuk Sion in Turkey pipeline, that's 250K. Guyana and Suriname have actually increased production as a result of this. That totals up combined about 1 million barrels per day. So if you add all of that up, we've been able to supplant about 40% of the energy supply that's been coming through the Strait of Hormuz. But again, even with that, it's still the largest constraint on supply in history, even with those efforts. So it is a major deal.
Do you think those efforts are sustainable? And one of the positive scenarios I suppose one could paint from this is that this just simply removes a future threat or an ever-present threat, and you build around it. And the thing about building around it, though, is that has to be as sustainable or less vulnerable than the strait itself. And this is where my ignorance comes into play. Are those options sustainable? Is further pumping of supply from some of those other smaller producers sustainable and sizable enough to be a full replacement at some future state?
Yeah, I think it is sustainable, and I think it's one of the incentives why the UAE decided to leave OPEC because again, they probably don't want to deal with this in the future, and it is a sustainable pathway. But again, there's still going to be if this, I don't think it'll go back to the same, but there'll still be a deficit, and the Strait of Hormuz is obviously a more cost efficient way to get the oil. But I think given what the GCC countries have experienced, I think they're gonna probably maintain these alternative avenues for the foreseeable future.
And one of the ways countries are presumably dealing with this is trying to hope that this is at least temporary, or at least of a short enough term that they can manage it through inventory. What is the state of inventories? How close are we to sort of either drastic efforts at massive destruction of demand or curtailment of air flights and things like that, rationing, however you want to look at it. How close are we to those points? And are there countries that are more vulnerable on that front than others where inventories are already lower?
China is in a very strong position. For example, they have an inventory about 1.2 billion barrels. The US, we have about 398 million barrels in our strategic reserves. Japan actually has about 500 million barrels. Europe is vulnerable. They only have about a, a billion barrels, but that's among all 27 countries. So that's very stretched. The most vulnerable, I would say, is India. They only have about 40 million barrels. South Korea, 100 million barrels. So I think those countries are very vulnerable to the point where they've already started canceling flights because of the increase in diesel costs and things like that. And there's other elements which we could get into a little bit later, but things like petrochemicals and fertilizer and all those things are also a major factor as well.
Well, yeah, I mean, I'm curious about that because when this whole started, people started to think naturally about what it means for food prices because you have the inputs into fertilizers that are going up, and plastics are in focus, and really oil goes into everything. We may think of it
Yeah.
as a headline CPI effect, but ultimately a lot of things are downstream of it, not just core things like airfares or plastics or other headline elements like food, but really the downstream effects are so vast. And I'm curious what we're seeing in those other kind of second order downstream commodities, and what you can say about that and where those vulnerabilities are popping up.
There's obvious vulnerabilities and then there's ones that are not so obvious. So I think the obvious, I think, real concern, if I had to point to one of the major concerns outside of energy, would be fertilizer. So 33% of global fertilizer comes from the Strait of Hormuz, but more specifically, ammonia and urea and sulfur fertilizer, which is highly responsible for planting food, specifically cereals, oil seeds, vegetables, fruits, corn, grain belt. That's about 80% of that comes from the Strait of Hormuz. So we're looking at a real possible in the second half of the year, if this doesn't get resolved, a possible humanitarian crisis, I would say, in most of the developing countries. So that's important to point out. I think one of the less obvious things that come from the Strait of Hormuz is helium. So helium is one of the major components that go into semiconductor production. So that's going to have an impact, obviously, on Taiwan. That's going to have an impact on South Korea, and have an impact, obviously, here in the U.S. because we source a lot of our semiconductors from those regions.
And I presume as well from some of those factors that you mentioned where upwards of 80% goes through the strait, the kind of building around it is less obvious. Is it impossible? Is it just simply a case of that, or is there in some future state the ability to circumnavigate it, or what's the status of things like urea and ammonia? Where can it come from if not from there?
Yeah, so a lot of it could come from Russia,
Okay.
but I don't think Russia's in a friendly mood to,
No.
offer up extra fertilizer production.
Yeah.
Outside of that, there's really not a clear alternative. So this is
Mm,
where I think, like I mentioned before, energy, obviously there's global supply, but this is a more nuanced, specific
mm,
area where I think when it relates to fertilizer, petrochemicals, and all of the other things that there's really no alternative. So that is where I think you start to get a proper supply shock
yeah.
with those commodities.
One of the other means by which you can lessen a supply shock, and as the old adage goes, the cure for high oil prices is high oil prices, and that comes through destruction of demand. And we've talked about some of the factors already, and some of it is curtailment of supply of services like airlines, airfares, or flights, I should say. But of course, some of that is going to be driven by lower demand. And I wanted to think about the demand side of this and any evidence you're noticing that demand destruction is taking place already.
So demand destruction, and I'll use the US as an example, it starts based on the gasoline price. So consumers start to get concerned psychologically once we get to $4 a gallon. So we've reached that mark, I want to say on March 30th here in the States. And then when we looked at it since 1970, every time you reach $4 and you get a 10-cent increase in gas prices, it starts to impact retail sales actually 2 months forward. So we're just around right about that time where I think you'll start to see, when we get to Memorial Day and so on and so forth, people getting concerned with the price at the pump, and you start to see some proper demand destruction.
Yeah, well, actually, the market effects are kind of the second big topic I wanted to talk about, and
Sure.
y- you know, your comments on energy or on oil specifically is that a lot of this is priced in, and I wondered if you had any difference of thinking when it comes to the broader equity market. And just to set the context, which I'm sure people who've listened to this and read show notes over the last couple of months will be well aware, institutional investors are positioned heavily overweight in risky assets, especially equities and tech stocks and all the usual stuff. They
Mhm.
never really de-risked. And volatility has reverted back to the levels it was at prior to this crisis, in some cases, lower levels in certain currency pairs. Are the risks around this, some of the things you're painting with respect to supply of not just oil, but the downstream commodities, the impact that has on demand ultimately, are those risks as well understood and factored into broader financial conditions, I guess, is the best way to put it?
I think there is some complacency, and I think where I think investors need to start to think about is, we're going to have winners and losers. I think it's hard to argue that the US is not relatively insulated. Obviously, we're a net exporter. We benefit from a terms of trade perspective. Our economy will still still stay resilient. There's probably less pressure on our long, our curve as it relates to break evens driving the long end of the curve. And the Fed will have probably less pressure to have to hike. We contrast that with obviously Japan, or we contrast that with Europe, we contrast that with the UK. They're under a lot more pressure and duress from an energy shock. And I think that's part of the reason why government officials in Japan decided to intervene or at least signal that they intervened. The ECB, I think the UK, the BOE have to hike in a circumstance where it's probably the last thing they needed to do or wanted to do. And I think that's going to cause some issues with those markets, those equity markets in particular. So from an equity standpoint, I think the notion the sort of trade we had on before the conflict is probably going to be a little bit different than the trade we have on post the conflict, or if it prolongs. You have to start to ask the question about diversification. is that impetus to want to diversify away from the US as compelling as it was, say, last year. And I would say it's probably, at least from a fixed income standpoint, you could see the US is our sovereign markets are behaving better than the rest of the G7. And I think that's a good indication of there may not be as much of a need to want to diversify away from the US.
Yeah, it is curious. I think bond markets, maybe outside of the UK, which does seem to operate under its own emerging market-like rules as far as how it trades, but bond markets generally, I'm not saying they haven't underperformed, but as an example, peak to trough this year, treasuries are down about 2%, and net since the start of this conflict, a lot of that drop actually happened before it, but since the start of this conflict, they're down about total return about 30 basis points, which
Mhm.
is astonishing for me, given you have had a rise in break evens. Why do you think rates have held up so well, or at least had more low vol sell offs than what we might expect?
Our markets or our economies are not as sensitive to energy price shocks as they once were in the past. And that's because of obviously technological advances, more efficiencies, as it relates to gasoline efficiency for vehicles, the advent of EVs. All of this stuff collectively has made our economies less vulnerable to energy shocks. And, evidence of that is inflation expectations, long run inflation expectations haven't really increased. So I think that's a function of, again, the evolution of technology, but then also this notion that this too shall pass. They have to come to a resolution. We will ultimately find a new equilibrium in the price, even if it stays at $90 a barrel. We can live with that and start to plan around that.
Yeah. Yeah. I mean, the dollar in the US is the interesting one here because, of course, it's had some strength, but now it's really come off the boil. And then and again, net the dollar is flat year to date. Maybe you've earned a little bit of carry against the G3, I suppose, but the gains to the dollar have been relatively modest. But at the very least, the dollar has started to take on whether it's a more positive correlation to volatility or negative correlation to risky assets, or if it's just a simple, it's an oil currency. It's taken on some support that it didn't have before. And I'm curious, given there are countervailing factors, a Fed that's maybe more likely to ease, that would damage the dollar potentially. Do you remain dollar positive as long as this episode goes on and look to sell it later, or is the time to sell it now, or is it just, you don't low conviction and hard to say?
Yeah, I mean, I'm still actually dollar negative. I mean, I think and the reason being is because it's kind of counterintuitive because our economy. So I think it's a function of which central bank's going to blink first, and because our economy is insulated and resilient, it actually alleviates the pressure for the Fed to have to hike. That's not the case with other central banks. Obviously, yeah, the RBA, they hiked 3 times in a row. You have, the RB and Z set the hike. You have the ECB, you go down the list. Every hikes are getting priced in across the board. The US has managed to, our rate market projections have managed to kind of stay flat. So from a relative monetary policy perspective, that should be dollar negative. And then obviously we have other factors like the twin deficit and then this whole notion of credibility with the Fed. I think those dynamics in the medium term will definitely, I think, keep the dollar, negative, or at least from our point of view, keep us with a negative dollar bias.
Yeah. Well, the institutional concerns are a nice segue to a part three of the discussion I wanted to have because, of course, in addition to being one of the main folks on the team who focuses on commodities and commodity currencies, you also follow US politics quite a lot.
Yeah.
And, it's clear, especially over the last 6 years since the pandemic, that inflation has political ramifications that we kind of had forgotten about because the 70s and 80s were so long ago, but they do. And I'm just wondering now what this episode means for the upcoming political cycle. The US voter is already pretty disgruntled. So the
Mhm.
starting point is pretty bad. Can it get worse?
it can get worse. I think just to give some context, the most recent average polling shows that the number one issue is inflation at 43%. The distant second is healthcare at about 11%. So just to give some context of what's on voters' minds. If it persists, if this crisis persists and gas prices stay elevated, then I think it becomes a worse situation for the incumbent. I think it's a foregone conclusion, just mathematically, that the Democrats in the US are probably gonna take the House. I think the variable is what's gonna happen in the Senate just because of the math, because Republicans have 53 seats, Democrats have 47. They would have to win 4 seats, which is not out of the realm of possibility, but we're in some very competitive races in Georgia. I would say Michigan and North Carolina. Maine, I think, is leaning more Democratic, but Georgia, Michigan, North Carolina, those are very tight. If inflation, persists, then there's definitely a chance the Dems could take the Senate as well. And another point, when we look at the congressional ballot, it's the lowest it's been in decades for the Republicans, which is a good leading indicator for who's going to win the Congress. And then Trump's approval rating is also a leading indicator for what happens in the midterms. The presidential's approval rating is the fourth lowest among all presidents in history. In every circumstance, when they had those low approval ratings, the two subjects that mattered were the economy and war. And on both of those fronts, it's not going so well, I would argue.
It there's a school of thought that they can get all the bad news out now, the war news, the inflation shock, the hit to consumer incomes, real incomes through energy prices, but that they have enough time to recover. And to be fair, you've seen stranger recoveries in political prospects, even with circumstances as worrisome as they feel. But there's surely going to be a point of no return at which even maybe the Senate math looks a little bit challenging. Do you have a sense of when that might be, as far as how much time they have to kind of frame this in a way that voters can see this as either a price worth paying or actually a successful effort where the worst of the energy price effects are expected to fade?
Yeah, it's typically after Labor Day. So if they can manage to get this thing sorted by, say, early summer, and they could focus on the economy, have some clear solutions. Because I think one thing to point out is it's not necessarily that the Democrats are winning, it's that the Republicans are losing. So the Democrats haven't, when you look at the polling, they haven't really made their case or really have a strong, compelling message just yet, just as it relates to what we're seeing in the surveys. So there's certainly still enough time for if they could get Republicans could get this resolved and hone in on a message and gas prices start to normalize. They have basically until Labor Day. But once you get post Labor Day, the school of thought is most voters have made up their mind. And not only have they made up their mind, in a lot of states they have early mail-in voting as well. So some actually start to cast their votes in September. So yeah, that's the window of time. I think they have basically until post Labor Day.
Okay, so there is still 4 months, let's say, and then 2 months to recover and to right the situation. Thinking a little bit longer term, I mean, you mentioned President Trump's popularity, the effects this is having on polling for Republicans. It's surely too early to think about the next presidential election, and of course, Trump will not be running for it, at least we don't think so. But are there lasting effects from this that potentially, as you say, no, the Democrats weren't exactly winning popularity contests. Even throughout this episode, they're not doing so. What does the setup for 2028 look like? Does this influence the thinking around that at all? And will its effects resonate into that long of a time horizon, or is it just too far in the future and too much can change?
I would say it's more so the latter because a lot can change in 2 years. When we think about the lasting effects, I think it's important to realize that it's so easy to say, obviously Trump is the one who pursued this war, but if the Democrats take Congress, for example, it's going to be their problem as well, and they're going to have to sort the problem, especially if the strait is not open. They'll have to work to address that. They can no longer just point the finger and, oh, this is Trump's issue. They'll have to have an actual solution. So that this is where it gets complicated, where it's politically viable to, criticize, but once the tables turn, both parties are going to be held culpable or responsible for this. So I think it's too early to tell, but I think it's definitely going to have some lasting effects. And I struggle to see how after this the Middle East will be the same, the Strait of Hormuz will be the same, and we're not stuck with, at a minimum, higher commodity prices than we had before this event took place.
Well, before I let you go, and we are almost at the end here, Noel, you'll be
Sure.
thankful to know. I did want to ask one more question about an idea you have for the coming couple of months, and let's kind of limit it to our area of focus that you and I look at, which is G10FX. And the Norwegian krona is leading the way at up 11% total return, followed by the Australian dollar. So two commodity currencies. The laggards are the Japanese yen, even after the intervention last week, the euro as well. So the two currencies you mentioned as being most exposed are the laggards. And I'm just curious, when it comes to expressing a G10FX view, what is your preference here for the next couple of months?
Yeah, so I have two preferences. I think the cat has been unjustifiably overlooked. You know, I think it was a lot of, people look at a lot of lagged data, economic surprises have been poor, but the tables are certainly turning. I think, retail sales, they had their 3 consecutive months of gains. That was the first time since July of 23. The employment picture seems to be at least normalizing. And then most importantly, the prime minister, Carney, basically has been able to consolidate power in the parliament. So he'll be able to pursue his industrial policy, which is an effort to essentially circumvent the US, be able to export, energy directly to Asia Pacific. Also, heavy investment in technologies of the future, military investment, all that's going to create a nice fiscal impulse. It was deliberately designed that way for the next 6 to 12 months. So that could help to, I think, turn the tide on the economic data. And then obviously, don't forget, they're huge energy exporter. So their terms of trade will also benefit. So I think I really like the CAD and I like it against the dollar. So one of my highest convictions is short dollar CAD. And then the second trade I would say would be the Kiwi, which I think they are just simply behind the curve as it relates to inflation. You compare it to Australia, they hiked 3 times, they're at 4.35%. The RBNZ, they cut several times. They probably need to take out all those cuts that they put through in the past 12 months just to get to a state that can basically handle the new inflation impulse. And it's not just headline, but it's also non-tradable inflation as well. So, yeah, those are my two highest convictions. I like the Kiwi. I would pair that against probably sterling, where I think the BOE will have to hike, but again, they're in no economic position to do so. So I think that'll do more harm than good.
Well, we have done more good than harm. I can safely say that. We've come away with a couple of great ideas. Noel, as always, fascinating to catch up. Some great ideas in there. Appreciate you taking the time.
Yeah, my pleasure.
Thanks for listening to Street Signals. Clients can find this podcast and all of our research at our web portal, Insights. There, you'll be able to find all of our latest thinking on markets, where we leverage our deep experience in research on investor behavior, inflation, media sentiment, and risk, all of which goes into building an award-winning strategy product. And again, if you like what you've heard, please subscribe wherever you get your podcasts and leave us a review. We'll see you next time. State Street Trading Trust Company, hereafter referred to as State Street, and is for informational purposes only. It is not intended to to suggest or recommend any transaction, investment, or investment strategy. It does not constitute investment research, nor does it purport to be comprehensive or intended to replace the exercise of an investor's own careful, independent review and judgment regarding any investment decision. This communication and the information herein does not constitute investment, legal, or tax advice, and is not a solicitation to buy or sell securities or any financial instrument, nor is it intended to constitute a binding contractual arrangement or commitment by State Street of any kind. The information provided does not take into account any particular investment objectives, strategies, investment horizon, or tax status. The views expressed herein are the views of State Street as of the date specified and are subject to change without notice based on market and other conditions. The information provided herein has been obtained from sources believed to be reliable at the time of publication. Nonetheless, we make no representations or assurances that the information is complete or accurate, and you should not place any reliance on said information. State Street hereby disclaims any warranty and all liability, whether arising in contract, tort, or otherwise, for any losses, liabilities, damages, expenses, or costs, either direct, indirect, consequential, special, or punitive, arising from or in connection with any use of this communication and/or the information herein. State Street or its affiliates may from time to time as principal or agent for its own account or for those of its clients have positions in and/or actively trade in financial instruments or other products identical to or economically related to those discussed in this communication. State Street may have a commercial relationship with issuers of financial instruments or other products discussed in this communication. This communication may contain information deemed to be forward-looking statements. These statements are based on assumptions, analyses, and expectations of State Street in light of its experience and perception of historical trends, current conditions, expected future developments, and other factors it believes appropriate under the circumstances. All information is subject to change without notice. This communication or any portion hereof may not be redistributed without the prior written consent of State Street. Past performance is no guarantee of future results.